Moat Main, hedge fund thinking for your daily life. Every few years, the same cycle repeats. A geopolitical conflict erupts. Oil prices spike. Markets panic. And suddenly, everyone becomes an expert. The headlines grow louder. The predictions become more dramatic. And investors everywhere start asking the same question: what should I do right now? Sell? Buy? Hold cash? Hide? Because when war and oil collide, it feels like the entire financial system is suddenly fragile. Your portfolio turns volatile. Inflation fears return. Gas prices rise. Consumer confidence falls. And the anxiety becomes contagious. But here's what separates sophisticated investors from emotional ones: the best investors do not react to headlines the same way the public does. They interpret them differently. Ray Dalio sees systems. Howard Marks sees psychology and pricing. Warren Buffett and Charlie Munger see durability and temperament. Nassim Taleb sees fragility. Naval Ravikant sees leverage and time horizons. And while their strategies differ, they all understand one thing most people miss: the real danger during uncertainty is not volatility itself. It's losing the ability to think clearly. Because once your thinking collapses, your trades become hostage to whatever story is loudest tonight. And the cruelest part is this: the story will change again next week, but the spread, the tax bill, and the permanently sold low tick, those can last. Oil is not just another commodity. Oil is embedded in the physics of movement. When oil prices rise, transportation becomes more expensive. Manufacturing becomes more expensive. Shipping becomes more expensive. Eventually, inflation pressures show up in places people actually feel: the pump, airfare, groceries, anything that travels. That's why geopolitical conflict near major energy corridors creates so much market fear. Markets aren't reacting only to morality or politics, they're reacting to a plausible chain reaction: costs rise. Margins compress. Growth slows, or gets repriced faster than growth itself. Interest rates react. Confidence shakes. Liquidity shifts. But sophisticated investors remember the second-order question: what is priced in, and what isn't? Because the scary headline is rarely the entire economic story. There are substitutions. Inventories. Policy responses. And human adaptation that isn't cinematic enough for cable news, but real enough for long-term portfolios. If you want a household parallel, an oil shock is less like a single bad day at work, and more like a rent increase and a higher grocery bill arriving in the same month. It hurts cash flow before it changes your identity. That's why markets swing first: they're trying to reprice the path of cash flows under stress. Which means volatility can be real, without your long-term thesis being worthless. And it's also why wait and see isn't denial, it's sometimes the only way to avoid paying twice, once in fear, and again in round-trip trading costs. This is where most investors fail. Not because they lack intelligence. Because they become trapped inside narratives. A market drops 3%, and suddenly every headline explains why civilization may be ending. Oil spikes, analysts predict stagflation. Gold rises, people predict currency collapse. The human brain desperately wants a coherent story. And financial media monetizes that desire. Because uncertainty is psychologically uncomfortable. Stories reduce discomfort. Even if the stories are wrong. Howard Marks often warns that investors confuse information with insight. The more emotionally charged the environment becomes, the more dangerous certainty becomes. Because during moments like this, people stop thinking probabilistically. They stop asking, what range of outcomes is possible? And instead ask, how do I escape this discomfort immediately? That emotional shift destroys more wealth than most recessions ever will. You can feel the trap in your language. When people say, I can't take it anymore, they're rarely describing new information. They're describing pain tolerance. And pain tolerance is not a valuation model. So here's a practical rule. If your decision's main driver is relief, pause. Relief is not a strategy. It's a mood. If you need a second rule, don't let a 24-hour news cycle set a 20-year plan. The clock speeds up in your head, but your actual objectives usually don't. Ray Dalio approaches crises differently than most investors. He doesn't focus on isolated events. He focuses on systems. Dalio asks, how do debt cycles, energy shocks, currencies, politics, and human behavior interact together? Because global markets are deeply interconnected. An oil shock can increase inflation. Higher inflation can pressure central banks. Higher rates can weaken economic growth. Weak growth can intensify political instability. One system pushes against another. And this is why Dalio rarely builds portfolios around a single prediction. Instead, he prepares for multiple futures simultaneously. His framework is not prediction. It's resilience. Cash reserves. Diversification. Flexibility. Optionality. These become strategic advantages. Not because they maximize short-term returns, but because they keep you alive long enough to benefit from long-term compounding. And that's the system's mindset in one sentence: don't bet the farm on your ability to forecast the next headline. Bet on surviving a world that refuses to cooperate with your forecast. Howard Marks believes the biggest investing mistakes happen during emotional extremes. Because most people operate with first-level thinking. War is bad. Oil prices are rising. Markets feel dangerous. Therefore, sell. But Marx asks a deeper question. How much fear is already priced into the market? Because markets do not reward consensus thinking. They reward expectations relative to reality. Sometimes the news is terrible, but prices already reflect even worse expectations. Other times, the headlines sound optimistic, while risks are massively underestimated. Second-level thinking forces you to separate the event itself from the market's emotional interpretation of the event. And during geopolitical crises, that distinction becomes incredibly valuable. Because emotional investors focus on headlines. Sophisticated investors focus on pricing. And pricing is blunt, it's everyone's fears and fantasies, compressed into one number. Your job isn't to be numb. Your job is to be precise. What would have to happen for today's prices to make sense, and do I believe that? Warren Buffett and Charlie Munger built enormous wealth on a deceptively simple principle: temperament matters more than intelligence. Especially during uncertainty. Buffett once described markets as transferring wealth from the impatient to the patient. Geopolitical panic accelerates that transfer. Because uncertainty creates emotional pressure. People suddenly feel compelled to act. To sell. To reduce risk. To do something. Buffett and Munger focus instead on durability. Essential demand. Pricing power that isn't hostage to commodity noise. Strong balance sheets. Businesses that can survive temporary chaos. Because in a crisis, you don't need a hero thesis. You need a survivability thesis. Munger famously emphasized avoiding stupidity over chasing brilliance. So during stretches like this, often the competitive move is boredom: fewer trades, fewer predictions, fewer self-inflicted wounds. That doesn't mean never change your mind. It means changing your mind for reasons, not for adrenaline. Nassim Taleb approaches uncertainty from an entirely different angle. He believes people underestimate tail risk, the rare shocks that reorganize assumptions overnight. Too much debt. Too little cash. Too little slack in the budget. Too much concentration in one paycheck, customer, geography, narrative. Taleb's point is not pessimism. It's humility. Volatile markets are normal. Permanent fragility is optional. Fragile systems collapse under stress. Robust systems resist. Anti-fragile systems learn and improve, sometimes slowly, but unmistakably over time. So ask the blunt question, if oil stays high for 18 months, if volatility persists, would your finances still function? Would your ego still function? Because real risk isn't squiggly lines. It's ruin. Ruin prevention is boring. That's exactly why most people refuse to build it, until Tuesday. Naval Ravikant brings another constraint that gets ignored, time horizon mismatch. Most people consume financial news on an hourly basis, while trying to build wealth over decades. That mismatch creates instability. News is engineered for novelty. Compounding rewards repetition and patience. Naval argues leverage takes many forms. Code is leverage. Media is leverage. Knowledge is leverage. Reputation is leverage. During geopolitical panic, short-term thinkers become reactive. Long-term thinkers become selective, not because they love risk, because they refuse to let noise eat their timeline. Here's Naval's distilled point: compounding defeats drama, when drama doesn't steal your calendar or your cognition. Your edge isn't being calm. Your edge is building a calendar that protects calm deliberately. There is another crisis danger almost nobody names. Information overdose. People assume more data produces better judgment. Usually it amplifies adrenaline. Because most updates repeat the same story with louder adjectives, while offering no decision-relevant marginal information. Meanwhile, your attention resets your risk thermostat upward. Hourly thinkers make hourly mistakes. You will see the same clip recycled. You will see the same expert invited back to say something stronger. That's not malice every time. It's incentives. So treat breaking the way a hospital treats triage. If it doesn't change your action list, it doesn't deserve your nervous system. Here's how elite practitioners behave differently. Before volatility arrives, they define liquidity needs. They define downside tolerance. They define what would change their mind, ahead of fear. During volatility, they default to execution of the plan, not improvisation under cortisol. Not prediction. Preparation. If you finish this video with nothing else, take this checklist: emergency liquidity that isn't gambled mentally as temporary. Portfolio concentration labeled honestly. News diet that doesn't turn your amygdala into your CIO. Sleep and decision hygiene, because stupidity hides in fatigue too. Systems beat sentiment. Especially when sentiment is monetized. Every generation believes its uncertainty is uniquely dangerous. Oil embargoes. Sudden geopolitical ruptures. Market crashes. Pandemics. Bank stress. And yet markets continue adapting. Businesses continue innovating. People continue building. This does not mean risk is fake. It means resilience matters more than prophecy. The goal is not to forecast every headline. The goal is to avoid becoming the volatility you're reacting to keep your footing when others trade their plan for applause. Because in the end, the investor who wins is rarely the one who panics fastest. It's usually the one who remains rational, while everyone else loses perspective, who can name what they own, why they own it, and what would actually falsify their view, without outsourcing that clarity to whoever shouts loudest on a split screen. And who remembers that compounding survives longer than panic, when panic doesn't get a vote in your brokerage account. Which framework resonated with you most? Dalio's systems thinking. Marx's second-level thinking. Buffett and Munger's temperament. Taleb's anti-fragility. Or Naval's time horizon discipline. Drop one name in the comments. And name the one habit you'll keep when the next headline cycle starts screaming. Moat Main, hedge fund thinking for your daily life.